Hello, everybody. Thank you for coming to see Damien and Louisiana from EQ Investors speak about the portfolios, which we've been using for several years now. Welcome to the advisors in the Loveday and Partners team who are here watching, and to anybody watching afterwards on catch up, clients or whoever else it may be. It's really exciting to have these guys with us today. They both have a lot of, they run the portfolio, and they're very, very detailed and very interested people in everything to do with impact. So really a fantastic opportunity to be able to listen to them speak. They've got a lot to tell you about today, case studies and sort of different advancements in the portfolios. So without further ado, I want to pass over to Damien and Louisiana and let them get underway.
Thank you so much, Adam, for the welcome. So just very briefly about myself. So I'm Damien Lardoux. I'm head of impact investing at EQ Investors, and also managing the EQ Positive Impact portfolios we're going to talk about today. But before talking about the portfolios, I was keen to briefly introduce EQ Investors. So we are a specialist impact and sustainable investment manager, and this is all we do. Although sustainable investing has become increasingly widespread, we're proud to have been one of the early innovators in this space. And we've gained a huge amount of experience since launching our flagship positive impact portfolios a decade ago. These are the portfolios we're going to talk about today. Today, we nearly manage 2 billion of assets in sustainable investments, and we're proud to be recognized by our peers as a leading actor in the field. We were also a founding member of B Corp, which is a non-for-profit network with the idea to transform the global economy to benefit all people, communities, and the planet. One of our primary objectives is to help you as a client to connect with your money. So one of the ways we do it is by bringing your investment to life with our in-depth reporting. And today we'll be talking about some innovations we brought to the space through our new carbon calculator tool. So if I give you a brief, summary of the agenda for today. So the presentation will run for about 40 minutes, slightly less, and then there will be about 15-20 minutes of Q&A. In terms of the presentation, what we're going to cover today is first the investment case. Why should one invest through sustainable investments? Then we'll talk about the EQ Positive Impact portfolios in a bit more details, and including some company examples, really to try to bring the portfolios to life. Then we'll talk about the markets. Obviously, it has been challenging this year, so keen to give you an update about our outlook and obviously how the portfolios have performed. And then also we're going to finish by talking about the developments we've made with the portfolios and give you an update on sustainability. So now I think this is the agenda presented. So I'm going to hand over to Louisiana. We're going to talk about the investment case first.
Thank you, Damien. Thanks, everybody, for listening today. So our portfolios that you may have heard about and invested in have a dual mandate to meet sustainability objectives and risk-adjusted returns. But I want to start off with, before we get into either of those two, start to explain the relationship between these two and why we think these two aims are actually reinforcing. So let's start with the first thing. The first aspect of sustainability here refers to an assessment of the corporate behavior. This is characterized by an assessment of a company's E, S, and G, and usually looks at how responsibly a company is run compared to its peers. Examples include an assessment on how well a company manages the environment it works in, how it treats its staff and surrounding communities, and also how well it is governed. And investing in companies that are leaders across these E, S, and G factors help us to avoid risks from being exposed to scandals that can result in huge stock price drops on the day. So for example, there's the BP Mercander oil spill that was a result of bad environmental safety behaviors, the Boohoo modern slavery allegations as a result of bad labor welfare policies, and of course also the Volkswagen emission scandal, which was a result of bad governance. So by investing in responsibly run companies, what we're doing is we're more likely to avoid these risks for your investments and benefit financially from the future fitness of the businesses that we invest in instead. The second link of sustainability and performance concerns big social and environmental challenges. So you're obviously aware that some of these big challenges on the screen, the challenges of climate change, water scarcity, the obesity crisis, and large populations still really lacking access to basic services. But, you know, these can be quite daunting. But what if we start thinking about these global challenges as an opportunity for some companies and for your investment? So sustainable investing can look for companies that provide solutions to these types of challenges through their core products and services. And examples are shown on the slide. Because, of course, these challenges are growing in size, and for the most part, that will continue to be the case, these businesses providing solutions are exposed to growing markets and can really benefit financially from the growing demand that results for their solutions. Also, of course, sustainable solution companies are backed by the likes of regulation and consumer trends. So all of these are financial performance tailwinds to investing in sustainable impact solution companies. Having explained that, let's dig into the EQ Positive Impact portfolios, and I'm just going to remind you of the objectives first. So the EQ Positive Impact portfolios are managed with a dual mandate in mind. We aim to maximize the returns for each portfolio risk profile, while also maximizing the positive impact on society and the environment. And we think these two objectives, as I just mentioned, are reinforcing and really strongly believe in the long-term outperformance of the businesses we support. To maximize the impact, we use the framework of the UN Sustainable Development Goals to understand the most pressing global issues that need tackling. And as the slide shows, we can summarize these types of issues in 3 pillars: people, planet, and prosperity. The frameworks on the right-hand side shows how we define themes that we want to invest in and those that we want to avoid. And I'm now going to go through the second part of the second lens of impact, which is engagement. Of course, we invest in solutions and we avoid those that do harm, but in between that, some companies are not perfect and we want to drive change. So another way that we do invest in positive impact and drive positive impact is through engagement. And we use the relationships of the fund managers that we work with to lift their ambitions and hold them to account. We also construct strategic engagement themes to improve the ESG credentials of the impact businesses, doing direct engagement through collaboration groups, for example. And this year, we've done so on digital inclusion, biodiversity risk, and climate targets. So now that you've understood the impact process a little bit more, let's dig into some company examples that bring this to life and show you what your investments have contributed to in the last year. The first company that I want to showcase today is a company called Abiomed, a developer and manufacturer of medical technologies. Heart failure in general is a massive epidemic in the UK and abroad. Actually, 460 associated deaths per day in the UK alone come from heart failure. And Abiomed is trying to help these numbers come down and provide a solution. So Abiomed's solution is the Impeller heart pump, which temporarily assists the pumping function of the heart to deliver blood to the entire body. Today, Abiomed's Impeller heart pump have been used to support more than 200,000 patients worldwide. And studies have shown that these patients have a much more stable recovery, significantly less tissue damage, and overall, this great solution leads to less days in hospital of patients, as well as fewer repeat visits and a swifter return to normal life. The next company I want to talk about is Wabtec, an industrial company focused on the rail industry. Let's talk about the challenge. So transport accounts for 25% of global greenhouse gas emissions, and high-speed rail can really serve as a strong alternative of transport to short-distance air travel and other modes of transport. Wabtec focuses on optimizing energy efficiency, the fuel usage, and minimizing waste in the train industry. This also, of course, helps cut the costs and the emissions by the train industry. So this company has positioned itself as a leader in the future of net zero carbon trains. In 2021, actually, Wabtec piloted its first 100% battery electric heavy haul train, and that's a first in the industry. Wabtec also looks to improve transport safety while doing so in a low carbon way. So for example, they have sensor enabled wheels and motors and brakes, and that predict maintenance before safety issues actually can arrive. And the final impact company that I just want to showcase is Pure Cycle Technologies, a company creating an innovative way of recycling plastic. The challenge here is that only 9% of globally produced plastic is actually recycled. And if it is, the use case of the secondary material is often quite limited. And the secondary material looks a bit like the black pellet in the picture on the left. Pure Cycle Technology is a plastic recycling facility supported by a green bond that our portfolios invest in. This proprietary facility, which is operational actually since 2021, is diverting waste from US landfills and is converting about 54,000 tons of plastic waste every year into transparent plastic pellets. Pure Cycle Technology will really facilitate change and scale up the circularity of plastic, and it does so through a unique process, which creates these odorless, clear plastic pellets, which you can see in the middle of the screen there, which can actually be used in a huge range of consumer and healthcare products. And this is opposed to the more gray or black pellets from traditional recycling processes, which actually only can be transformed in a very narrow set of use cases and definitely would never end up in a healthcare type of equipment, for example. Great. So after these case studies, I'm going to hand over to Damien, who's going to take you through the financial markets.
Thank you very much, Louisiana. So let's now talk about how markets have performed and our investment outlook. So, I mean, the third quarter of 2022, the last few months, they've been dominated by a rebound in equities, but followed in September by a significant drop in equities, bonds, and commodities. So if we look at the last few months' performance, global equities are only up in sterling because of the currency depreciation we've seen in sterling. UK emerging equities are slightly down, but the last few months have seen bonds, particularly sterling bonds, performing worse, down double digits over the last few months. So if we look at if we take a bit of a wider investment horizon, looking at year-to-date performance, so since the beginning of the year, equities are down about 10%, with losses in equities limited by the 17% drop in the value of sterling versus the US dollar. But what is making this equity sell-off challenging for portfolio construction is the even larger losses experienced by bonds, with sterling bonds down about 25%. And this is the biggest drawdown we're seeing in bonds for over 40 years. So if we look, what has been driving in the falls in 2022, inflation obviously has been the key culprit. And inflation, particularly core inflation, which is inflation without energy and food, are surprised on the upside over the last few months. And this has been pushing central banks to keep increasing interest rates and markets to reassess where the terminal rate is. So terminal rate is, how far central banks will go with their rates increases. And what the markets have been doing this year is pushing that rate high, expecting that rate to be higher and higher. So if we look in the US, for example, which is on the left-hand side here, you're seeing how much the US government is paying in percentage when they want to raise money on the financial market. And you can see on the left-hand side is, with short maturities, on the right-hand side of the graph with long maturities. And I think, the key thing you can see this year, if you compare the green line with the pink line, clearly what you've seen this year is a significant increase in interest rates. So basically governments need to pay more if they want to raise money on the financial markets. This is focusing on the US. The UK is pretty much the same picture. If you compare the green line versus the pink line, you can see a significant shift up, meaning that the governments have to pay a lot more when they want to raise debt in the market. So what I think is important to say at this point is that the markets now are pricing in a number of future rate hikes. So at the time of writing, so I was speaking, the US rates at the moment are, so the central bank rates are at 3%. Market is expecting them to go as high as 5% by mid-year next year. And in the UK, they're expecting to go to just under 5%. So what that means by that is that although you will see some future interest rate increases in the coming months, this is already what the market is expecting. I guess the key question is, will the market will expect more interest rates? And we think we are at a bit of a pivotal moment now where we're starting to see yields peaking, and that if that is the case, and if central banks don't raise interest more than what the market is expecting, that could mean potentially yields in the future going down. So inflation is a key culprit, and obviously of the market weakness, and the inflation start getting under control, meaning that central banks don't need to raise more interest rates. That should be supportive for markets in the months and quarters to come. But obviously, one of the issues of the central bank's rising interest rates and making the fight against inflation the main battle, sometimes the only battle, it means that they're putting a significant risk on economies to go into recession. And the risk of recession in the coming 12 months, according to Bloomberg Economics, is at 50% in the US, 60% in the UK, and over 70% in Europe. So clearly, this is a significant risk, and we're already seeing a number of what we call leading indicators turning into the red. So that would include, for example, consumer confidence, which is at historical lows. We're also seeing the housing market starting to show some weakness. We're also seeing the manufacturing part of the economies struggling, whereas the services economy for the time being remain resilient. So the reason why it is important is that as economies go into recession, that is likely to put less pressure on inflation and be another reason for central banks to not do more than what the market is expecting in terms of future rate hikes, but potentially even do less than what the market is expecting. And if that is the case, then that should also be supportive to equity and bonds in the months to come. But there remains a huge amount of uncertainty, I think it's fair to say, because so far inflation has proven to be a little bit stubborn, and but it's clear that the fight by central banks is to really focus on inflation. The other topical issue worrying investors is the energy crisis, particularly in Europe. It's fair to say at the time we are recording this that we've had a relatively warm September and October, which has put less pressure on our economies. But if we think about the winter coming, we've seen several analyses showing that if the EU and probably the UK as well wants to be able to weather the winter coming, they probably need to cut their gas consumption by around 15%. A huge amount of that will be done through energy efficiency, probably us heating our homes by a degree or 2 degrees less than we used to. That should do most of it. In Germany, they need to do a little bit further, go a little bit further, and potentially cut by 20%, depending obviously on how cold the winter will be. But I think what I think is important to think about as well is that this is not only a 2022 issue or winter 2022-2023 issue, because if we use all our gas reserves by March next year, then how is it unlikely we'll be able to replenish our reserves by the next winter. So this is clearly something that we need to keep a very close eye on. But obviously, what I think is really important, if anything, this energy crisis is showing how important renewable energy will be to build our energy independence. And we want actually to share some good news we've seen coming from the US. And this is particularly impacting the environmental sector we invest in via the EQ Positive Impact portfolios. So while climate solution companies, are always supported by the long-term mega trends that actually Louisiana was talking about earlier on, regulatory changes can create significant spurts of growth. And focusing on the US, previous policy commitments to support the domestic low carbon transition did not meet expectations. However, and this is the good news, this is changing. The Inflation Reduction Act, which was passed this August, is promising an additional nearly $300 billion of investments to tackle US sources of emissions. And this commitment will boost several sectors, including companies involved in renewable power, electric transport, and energy efficiency technologies. And because our portfolios invest in environmental equities, they're set to benefit from this directly, for example, through funds you own in the EQ Positive Impact portfolios, such as the Impacts Environmental Leaders Fund or the 91 Global Environmental Fund. And the reason why renewable energy is going to play a big part is also because we've seen a significant decrease in the past 10, 12 years in the cost of renewable energy. Just to put that into context, the cost of solar panels have dropped since 2009 by nearly 90% and onshore wind by about 70%. So now, onshore wind and solar is the cheapest form of electricity in most places in the world. And this in itself presents a tailwind to renewable energy companies as more utilities want to build out the capacity to reduce their cost. But looking ahead, which is on the right-hand side, this is even further supported by incoming net zero regulation. To meet our 2050 goals, which by the way is legally binding in the UK, the energy sector will need to transform itself to be predominantly powered by renewables, as shown on this diagram. And this is one of the trends emerging from our climate transition, to which our portfolios invest in and will benefit from. So let's now talk about the portfolios in a bit more details, how they're currently positioned and how they've performed in this changing market environment. I mean, the first thing to maybe to update you on is how do we think that portfolios should be positioned in this changing market environment? But we believe that the downside risk to economic and corporate earning growth remain elevated due to, as I was saying earlier on, fast rising interest rates, relatively stubborn inflation, which keeps going up, and an uncertain energy outlook. But with, as I said earlier on, with central banks now making the fight against inflation the main and often only priority, a global recession is fast approaching. So with this backdrop, our portfolio remains defensively positioned, focusing on high quality companies with low leverage of debt, and with also good visibility on their future earnings, and obviously make sure that their earnings are recurring. I mean, we also believe that companies with earning growth, which are highly dependent on the economic cycle, we believe that those companies will struggle. And that will include sectors like mining, energy, or banks. And within fixed income, there's still a huge amount of uncertainty. We think in terms of where inflation is going and where interest rates will go. So we'd rather stay focused on short-dated bonds, which actually do now offer a very interesting interest rate or very interesting yield, 5-6%. And we will look to increase the maturities we invest in our portfolios and also then increase the yield that this part of the portfolio can generate in the months and quarters to come when we have more confidence that central banks' rate increases cycle is coming to an end. So in terms of performance, as you can see, if we compare, the portfolio's performance against traditional peer group, if we focus on the right hand side, which is the year-to-date performance, it has been a challenging environment for portfolios, and what has been challenging is a number of the companies we invest in are fast growing, and with interest increasing, they've seen the valuation coming down, despite actually generating very strong earning growth and good results. And what we don't invest in, the energy companies, the Shell and BP, the mining companies, also the banks, the tobacco, the armament companies have been doing relatively well this year. This is starting to change a little bit, which you can see in the last few months. So this is as of end of September, and October actually is showing the same picture, is our portfolios are starting to perform better on a relative basis, because the narrative is changing from being concerned about inflation for now being concerned about recession. And I'll explain a bit later why we think our portfolios should be able to perform better in that environment. If we look at longer term performance, our portfolios are still, have been performing well over 3, 5, and 10 years, and ahead of more traditionally managed portfolios. We believe that actually 2022, which has been a bit of a step back for the portfolios that we've been running for 10 years, is the exception. And we strongly believe that over the medium to long term, the mega trends that we're benefiting from will help the portfolios strongly rebound and perform well. But going back to what I was saying earlier on, in terms of the narrative shifting from being worried about inflation to being worried about recession, I think that you might find this slide, particularly if you focus on the chart on the right-hand side, of interest. So what we're showing in pink is the year-on-year profit growth of our companies that we're investing in through the positive impact portfolios. And you can see, if you look at these pink bars, year-on-year, over the past 4 years, profit growth has been around 20 to 30%. If we focus, relatively stable, if we focus on the gray bar, you can see that, and this is focusing on the UK market, you can see how this is a lot more volatile. And we know the UK market is a bit of a proxy for a number of the sectors we don't invest in, like energy sector, the mining sector, the banking sector, particularly the likes of HSBC or Lloyd's, tobacco, or armaments. And those sectors, they tend to be quite cyclical. So they do really well when economies are booming, but they struggle when economies are slowing down. And this is the next phase that the markets, the economies will go into, and this is the next phase that the market will also go into. And we believe that our companies, their earning growth is more resilient. It's quite clear that we need to transition to net zero. And the solution that can help us transition to net zero will need to be implemented, including renewable energy. If a patient has a drug treatment, irrespective of the economic cycle, he or she will need to take his or her drug treatment. So that's why we believe that the companies and the themes we invest in should be more resilient in the potentially recessionary environment we could go into. I also wanted actually to give a bit of an update on some of the changes we've made in the portfolios, and that includes a new asset class, or a new theme, if you want, in the portfolios, which is UK infrastructure. What's very interesting about infrastructure more broadly is that the cash flows are linked to inflation. So in an environment where inflation remains high, then the cash flow that we're receiving from those investments rise with inflation. So this is a very interesting addition to the portfolios. And this is particularly focusing on the UK market. And if we talk specifically about the UK green infrastructure market, what's interesting to see on the left-hand side, you can see in light purple how renewables over the past year has been becoming an increasingly important part of our energy mix and electricity mix. And that is due to actually a number of companies listing in the UK stock market, such as Greenco UK Wind or Next Energy Solar, for example. And those companies, what they are a wind farm operator, for example, for Greencoat, or Next Energy Solar is a solar farm operator. And those companies are really helping the UK to build its energy independence. And as they're raising more and more capital that through your investment, you're helping to finance, then we're helping actually our economy in the UK to become more energy independent. And this is actually renewable energy. We know one of the issues is not always produced when we need it. And what's very interesting, we're seeing more and more companies like Harmony Energy Income Trust, which is providing some battery storage, because now the technology is efficient and can be scaled up. If I give you one example of a company we invest in, is Greencoat UK Wind. It's one of the FTSE 250 actually companies, so it's actually quite large, and it's operating primarily in the UK and invest in onshore and offshore wind farms. This is a company which is really making a significant impact to our lives, because it has installed, for example, over the past, it's installed over its life, over the past 10 years, the equivalent of energy needed by 1.5 million homes, which is quite significant. And what's very interesting to see on the right-hand side, you can see how this investment has been actually performing in line with inflation, actually even outperforming inflation. So this is a very interesting addition to the portfolio that we've added this year as a way to help our portfolios benefit from inflation staying higher for longer. So this is concluding the financial update. I'm now going to hand over to Louisiana, which is going to give you an update on sustainability.
Thanks, Damien. I want to, in this update, I want to showcase some highlights from this year's new impact report. We actually launched our 6th annual impact report for the portfolios last month, which is the culmination of a big research project aiming to measure all the impacts associated with the portfolio strategy and your investments. So please ask your financial advisor for a copy if you've not received one and you'd like to have a deeper look. But let me share you some key findings. So the next slide shows one of those findings. The analysis here looks through all the underlying holdings of the EQ plus impact portfolios compared to 2 market indices. And these 2 market indices, a global and a UK one, are more kind to the type of investment you'd have if you didn't have a sustainable mandate. So what does the research show? Well, about 80% of the positive impact portfolio companies provide solutions to world social or environmental issues. And this is about 30 or 40% less in the market indices. And another research finding is that we do not have exposure to companies that provide significant harm to people and planet, versus you can see the black bars do appear in the global and the UK benchmarks. And it's actually quite astounding that some people, I guess, aren't aware of this very overarching conclusion that if you, let's say, invested in the FTSE 100, about 1/3 of your investments would be flowing towards companies making the world a worse place. So I'll leave you with that. The second difference is that so a different lens of sustainable investing is to look at climate change and carbon contribution. And here, what I'm showing you is the associated emissions and therefore climate change impact of the positive impact portfolios on the right-hand side and the same 2 market indices, a UK and a global one. And as you can see on the right-hand side, we carry significantly lower emissions and therefore climate risk. And this is also part of our long-term objective. And to bring this to life, we've created a new tool, the carbon calculator. And this tool will showcases the difference of your investments in the positive impact portfolios in terms of their carbon footprint versus the world equity benchmark. And we convert this into easy to understand metrics like how long you could drive a car for and how much those emissions would be worth, or how many emissions are embedded in eating a cheeseburger because of the significant carbon impact of beef. All of these can be accessible in a personalized format. So please do ask your financial advisors for a copy of your personal carbon report. And also every year we dig into underlying equity and bond holdings in the impact portfolios and gather data on the core business practice impact and try to quantify the intentional impact that these businesses are making towards the goals. And here what I'm showing you is the associated social impact with 1 million invested in the EQ Positive Impact Adventures portfolio in the last year. So highlights include nearly 600 medical interventions, over 180 people treated, 5,000 hours of education delivered, and 40 people being given access to financial services in emerging markets. And this can be this is accessible. I'm showing you here the environmental impacts associated with the exact same amount. But what you need to remember is this is a tool for your financial advisor to use to provide a personalized impact report for your investments in the portfolios. So please do ask for it and you can see what great things your money has been supporting over the last year. So with that, I think our presentation comes to an end, and we've got, I'll invite Damien and Adam back to the panel to talk through a couple of questions on our portfolios and the presentation.
Hello, thank you very much, Louisiana and Damien. Much appreciated, as always. Very interesting stuff on the case studies. Thank you. As you said, I've got a few questions from the team here. I just want to sort of say up front as well, for anybody watching, obviously you're not live, so we can't ask any questions that you type in the chat. But if you do have any questions, please get in touch with your advisor, and they will be able to speak to Damien and to Louisiana and get you an answer. So that'll be great. First up, are there any legislative outcomes that we should be on the lookout for that would help achieve the SDGs and boost the portfolios financially?
Yeah, I mean, I can start with that. So I think the most obvious one is climate change. We have COP27 coming up actually this week, depending when you listen to this, it might already be over. We anticipate a couple of new regulations coming out of this, strengthening the implementation of the commitments made last year. Some things that you could look out for is greater kind of clarity on things like carbon pricing. Carbon price is basically like a premium that you need to pay in order to pollute. And that will be almost a market instrument that will really materialize climate risks of some companies versus others. And with that, as a sustainable investment manager, it really benefits us compared to the average market portfolio because we're already investing in companies that are providing solutions and therefore are lower carbon risk. I've shown you the slides just now. We have significantly lower emissions, therefore significantly lower carbon risk. So that's great. That's one of the things, and that will help us achieve I guess the climate goals of our economies. We've seen an example of this in the US and in the EU through the Renew Power program. We think that people will learn from this and implement that as well in their economies, waiting for the UK one to come out. That's one example. There's a couple of others. So for example, in respect to social outcomes, so you can think about the edtech space being supported in certain emerging markets. So educational technology can really help provide access for cheap, for example, to tertiary education that is really growing in some emerging markets. So people don't need to travel far to universities. And this is really a great enabler for moving people out of poverty. So there's a fantastic regulation going on in Brazil who's just changed their government. So we can see things coming up along, and we're excited about that.
Brilliant, thank you. Yeah, that does sound exciting. The next question I've got for you, Louisiana or Damien, whoever wants to take it. In the context of the energy crisis, what is the outlook for green energy businesses?
I'm happy to start. Yeah, I mean, I think there's two sides of the question. Maybe to maybe think about energy companies and then think about why we think renewable energy are better companies. I think we already touched on that a bit during the presentation, where we did explain that first, actually, on a cost basis, onshore wind and actually solar have actually become the cheapest source of energy in most part of the world. So it just makes sense actually as financially for us to have more more renewable energy installed globally. But what's also very interesting is now you also see, and the US is a great example of that, touch on that, is that they passed this Inflation Reduction Act where they are, through tax cuts and then grants, they're going to encourage people to make their homes more energy efficient, to build more renewable energy infrastructure, and then also more push for more sustainable transportation. So we think that actually these two parts, the regulation being more supportive, and the and just the financial kind of the cost, being quite competitive now. I think we still think should be strong tailwinds in actually in the short and medium term. I think what this energy crisis is clearly showing us is that we, in the UK, but many other countries, we need to be more independent when it comes to where we source our energy from, and probably don't rely on any one country. And what the big issue, probably issue that Europe is facing has been relying too much on Russian gas, and countries like Germany have been so successful on the back of very cheap energy. I think what renewable energy is going to help achieve is make us more energy independent, particularly as I said earlier on, battery storage is coming along for us, but then so these reasons for us are great reasons to invest in the sectors. But if I maybe briefly touch on energy companies, because sometimes we hear about people saying that these companies have become green, and that I just want to say that is not the case. These companies, most of their investments, most of their revenues, and the vast majority of their profits are coming from the exploration and the production, distribution of fossil fuels. And we actually at EQ, we're concerned about those businesses in the medium to long term, because they're not transitioning fast enough to a net zero economy. And that is, I guess, over the medium to long term, they could have a huge amount of stranded assets. So the reserve that they can't exploit. But then the other issue as well, in the more short term, is that as the economy is going to recession, potentially energy prices go down. That could prove to be a headwind for those companies as well.
Fantastic. Thank you, Damien. The next question I've got is about low carbon energy sources. So things like renewables, green hydrogen, nuclear, battery tech, that sort of stuff. What's the portfolio exposure to that sort of stuff? And, how do you sort of see that changing, please?
I'll start off. The good thing is that our reporting can show you. So we've got a UN Sustainable Development Goal mapping on all of our fact sheets. You can see the exposure to renewable energy, which is Sustainable Development Goal 7. It's about kind of 12%, I think, at the moment but that's not all. So that is just the actual, let's say, the solar panel provider or the renewable utility. Behind that is a whole, I guess, ecosystem of supportive or enabling technologies that we also invest in, which will be mapped to Sustainable Development Goal 9. And an example of that would be, for example, the semiconductor within a solar panel, or the electric grid that is connecting to the wind farm. All of these things we want to support, and we think holistically about the climate change crisis, and we want to support all the different bits of the value chain, which are kind of spread across the SDGs, but yeah, it's a significant portion of the portfolio. And as Damien outlined, I think what you gathered from his chat just now, we do not invest in the, I guess, the traditional energy companies, which we think are, sure, they've had a good role this year, mainly because of trading activities and so on, and of course the high gas price. But we think that there's a lot of headwinds to come for them. So we'd rather stay clear.
Brilliant, thank you. Okay, the next one. Could you explain, please, which sectors are overweight in the portfolios and how that might change over time? I know technology, for instance, has often been seen as overweight.
Yeah, so you're absolutely right. So if I just rewind a little bit, so as Louisiana explained, what the focus is for the positive impact portfolios is into companies that are providing innovative solutions through their product and services. So a lot of those companies can be found in the technology sector. You're absolutely right. Whether it's some cloud solutions, whether it's some companies helping with hybrid working, and so that we need to travel less. And so technology will be an kind of a key theme in our portfolios. So has healthcare as well, you know, particularly the companies providing some innovative solutions. So that's, if I add as well kind of the energy transition, that would be the three key themes, you know, technology, healthcare, and the energy transition. What I think is so for us, this is really core in our portfolios. This is the core allocation, and we're very excited about those. I mean, if I just maybe could give you one example, the company that Louisiana talked about, Abiomed, early on as a company example. Well, that company earlier this week has been announced that Johnson & Johnson is going to they want to buy that company at a price 50% above the current market price. So clearly what is showing is a lot of those incumbents that have been around for a long time, like Johnson & Johnson, which are not growing their profits and revenues, you know, as quickly as they used to. They need to find new areas of growth, including some of the companies that we are very excited to be investing in. So just to give you as well an idea, I guess, of the potential upside we see in the companies we invest in currently, because some of these companies have seen the share price coming down, but clearly other actors are seeing great value there. So for us, you know, for over the medium term, we're very optimistic about, you know, portfolios bouncing back. What we've done a little bit maybe at the margin is, as I said earlier on, is that make the portfolios a bit more defensively positioned. So within renewable energy, for example, moving a bit more towards the infrastructure side, which is with a much more predictable cash flows. And as we see the environment changing, then we'll go a bit more towards these the companies more involved in the value chain of renewable energy, for example. So we are adjusting the portfolio allocation depending on the market environment, because I mean, Louisiana and myself, we also invest in the portfolio, so we want to achieve the best return for yourself and for ourselves as well.
Fantastic. Thank you, Damien. If I could just ask you to sort of expand on that as well. I mean, you mentioned about acquisitions and how, you know, falling share prices in these types of businesses might lead to more acquisitions. If we see companies like Johnson & Johnson, well, I guess they've got a reasonably okay record, but, you know, acquisitions from big businesses, do we think that we're likely to see sort of any dilution of the sustainable credentials of the companies that are being bought once they become part of the bigger company?
There's always a risk. You're absolutely right. And actually what we would prefer is those companies to to actually keep growing because it has a fantastic product and keep innovating. And sometimes you're right, those acquisition that they don't end up well. There is a great example of that is a DNA sequencing. There is a company that we invest in that back in 2012 was about to be taken over, and actually some of the fund managers we work with told that company, a company is called Illumina, that you should not accept that actually great check they're putting on the table because your future is fantastic. And actually that was the right thing to do for that company, and with the progress they made around DNA sequencing was actually quite pivotal to help us fight COVID-19, for example, about 2 years ago. So yes, but then this is probably the point as well when these companies get taken over by maybe a company like Johnson & Johnson, in which we are a bit less excited about, then we'll be moving on to another company that we see as innovative and in which we can see some great, upside over the medium to long term.
Fantastic. Thank you, Damien. That's useful. Are there any sort of planned changes to the portfolio that you can let us know about at this stage, please?
Yeah, so maybe if I just carry on. Yeah, so for the time being, we're still remaining defensively positioned, so we may have a bit of a higher cash allocation than usual. That should be invested in months and quarters to come, but just waiting for a bit more confidence that inflation is under control. Infrastructure alternatives that providing a linkage to inflation remains something we're excited about. So you might see a new fund added to the portfolios in the coming weeks, focusing specifically around green infrastructure that we're very excited about, as I think you heard us early on. And then also what's exciting is that we keep brainstorming with asset managers about new ways to invest, providing also very interesting diversification enhancements to the portfolios. So you could see probably potentially some changes in that vein as well. But the vast majority of the portfolios won't change in the months to come, because as you know, we tend to have a relatively low turnover. We want to back the fund managers and the companies we invest in, because we believe that actually they're great investments when we take a medium to long term view.
Fantastic. I've just got a couple more questions, if you don't mind. Could you please give us an example of any of your engagement activity over the last year or so, please?
Sure. Yeah. So the EQ Positive Impact Report that I mentioned earlier details 4 of those, but I'll just pick 2 to give you a little flavor of it, one environmental, one social. So biodiversity, well, a lot of fund managers and asset managers have not thought about it until probably the last year or so. Climate change has been the main agenda point. Biodiversity risk, however, is kind of almost as systemically linked to many corporate behaviors. It can manifest in the way in supply chains, so the products purchased in order to create something, in the food value chain, and deforestation, and in real estate. So it's linked to a lot of ecosystem local impacts. And so we analyzed our portfolio's exposure to the Forest 500 companies, which is basically a list of companies that are linked to deforestation. It was already very low, significantly lower than others. We had 18 out of 500. This is it within the value chains only. And what we've done is we engaged with fund managers in order to see, first of all, how they're assessing biodiversity loss risk in the companies they back, and then how they're integrating these new findings from this organization in their engagement with their underlying companies. And we've actually managed to achieve them to really integrate that into the next year's engagement round within these highlighted companies, which is great, which means that not only will we reduce the risk over time, but also create a positive impact on biodiversity restoration. The second thing is on a social impact, so digital inclusion. So we invest in lots of technology businesses. Damien mentioned this earlier. Digital companies often have great products, but the positive impact associated with the products can only really be maximized if the access to them is kind of democratized and it's easy to access. And with that comes, I guess, an assessment on how much these companies are trying to get it to niche parts of the market, to developing nations, to, for example, minorities, including the female part of the population in certain bits. So what we've done is we've worked with the World Benchmarking Alliance, which has created an index of companies and looked at how these companies are doing that and highlighted weaknesses in some of their behaviors. And we're actually using that research, again, an independent source, in order to engage with fund managers on these companies and trying to improve their already great products, but increase their positive impact over time. And that's already been great. I'm on a call next week with PayPal and try to understand how they're marketing their so they have an artificial intelligence platform, but whether there's biases within that, because without artificial intelligence, the outcome depends on what you put in. And if you put biased data in it, the outcome will be problematic. So what we're dealing with is trying to help them become more accessible, fairer, and hopefully create the positive impact through their products and services and targeting underserved population.
It sounds fascinating. Thank you, Louisiana. Yeah, it sounds brilliant. I mean, the last question I had, I think you've both kind of touched on it already in quite some depth. So I guess really, if there's anything else you think needs to be said, is probably the best way to tackle this question. It's really about how you find out information about the companies and the kind of research you do, how much do you rely on fund managers giving you information versus, you know, doing the deep dives yourselves? I know you just said obviously about the Forest 500, and that's something you've done and taken to them. Yeah, if there's anything you'd like to expand on that, that'd be really useful, please.
I think to keep it short, we do not rely on fund manager research. And the reason, and we need to do this because there's a lot of greenwashing out there, and we really need to cut through the messaging and don't take their data as, you know, as the truth. And that's why we do our own underlying research on all of the underlying companies that a fund manager may present to us to able to test their processes actually work and evidence that to our investors. And through doing our own research, we can also compare fund to fund. We can look at how much impact is associated with this water fund versus this other water fund. And it's really important we do that. It makes us be on top of what we invest in at every point in time. So we do underlying research, but also, having said this, there is value in external data providers. So for example, for our carbon data, we do work with MSCI to get more scope 1, 2, and 3, so the entire value chain of a company's emissions, in order to have a full picture of our portfolio. But again, that's not coming from the fund manager, that's an independent source. So we do our own research, external data as well, and do not rely on fund managers only.
Brilliant. Thank you very much. I think that's pretty much all we've got time for. So thank you very much, Louisiana and Damien, for taking part and for, you know, distributing the information that you both got in your heads. It's really, really useful. I'm sure our clients will find it really interesting. Thank you very much. As I said before, if anybody watching this does have any questions, please get in touch with your advisor or your planner at Loveday and Partners, and they will be happy to pass your questions on to Damien and Louisiana, who are also always very, very happy and very quick usually to answer those questions. So and detailed as well, which is nice. Thank you very much, guys. Any final words?
Well, I mean, thank you for listening. Thank you for your ongoing support. And if you do have any questions or want to speak to us, we're there and we'll be delighted to do so.
Brilliant. Thank you very much, guys.
Thank you.
Thank you.
Bye-bye, everyone.